Today, I'm going to be teaching my friend Mache how to trade options in the stock market. You've got $500 in your Robinhood account. Oh, you're filled! Okay.
Got it.
All right, so at the end of this video, we're going to check back in and we're going to see if you ended up making money or if you blew up your entire $500 account. Do you know anything about trading?
A little bit. I know the basics, but I'm not an expert, so I guess we're gonna learn something new today.
Yeah, and you're like really excited for this, and
yep.
I love the enthusiasm. And I just want you to choose a random stock.
Okay.
And what we're gonna do today is we're gonna trade options, and I'm gonna teach you a really simple, beginner-friendly, but very effective options swing trading strategy. But before we dive into the strategy, I just want you, without knowing anything, to just buy a random option contract. Do you have any stocks in mind, any companies that you want to buy an option contract on?
Yeah, so I was actually thinking about what I'm going to pick for today, and I want to go with Tesla.
Okay, why Tesla? Why Tesla? I know everyone knows Tesla.
Yeah, it's like super overvalued, and its value goes up and down randomly, so I guess it might be fun.
Okay, I already have an idea that you want to bet on Tesla going down, so maybe I'm wrong. Let's pull up Tesla. Now, if you search here, you can type in TSLA, you know it. Now, with options, you can either bet on a stock going up or down. So you're either going to be buying what is called a call or a put. So a call, you're betting on the stock to go up, and a put, you're betting on the stock to go down.
Yep.
And so if you click on trade, and you click on trade options, the first thing you're going to have to do is choose an expiration date. So a date at which your option contract is going to expire. So this is a bet that is like a ticking time bomb in a sense, where it's either going to blow up in your face and you're going to lose the whole amount you have invested, or you're going to make a ton of money. Options are leveraged, and they're leveraged 100 to 1. So like with only $500, you could actually end up making a significant amount of money. And that's why, or losing it. That's why, like, as a beginner, options are great as long as you understand the risks and you have a strategy, which obviously we're going to cover in this video. So when it comes to expiration date, the closer the expiration date, I will tell you this, the riskier those contracts are.
Okay.
And the further out, the safer.
Okay, so we're probably want to go a bit further.
So it depends. Do you want to be risky? Do you want to be safe?
I mean, $500 is a lot of money, so I'm kind of stressed, but... do we have enough money? Yeah, we do. Because they cost like $20 each. Yeah,
when you look at the price here, it's actually...
$200.
So remember, the leverage here, you're going to have to move the decimal. So instead of $21.15, it's going to be $2,115.
$2,000, okay.
So those are like out of your budget. You're going to have to, unfortunately, because you do have a smaller account, you're going to have to buy contracts that are closer expiration. They're going to be cheaper. Again, they're riskier, but there's more upside potential, more risk, more reward. And then when we're looking at these right now, the January 2nd contracts, we've got the buy put, the buy call. So let's say we're looking at calls. We can see the current share price is $461.32. Now, anything below the current share price, the 460, the 457.50, the 455, it's going to be considered an in-the-money contract. So these are all in the money, in the money, in the money. And on the other hand, anything above the current share price, so 462.50, 465, these are going to be out of the money. Anything out of the money, these are all going to be riskier.
Okay.
So again, expiration date, closer to the expiration, riskier, further out, safer. With the actual strike price, the further in the money, the safer, the further out of the money, the riskier. So you can choose a closer expiration, but further in the money. Okay, so you can kind of balance the risk and return or risk and reward.
Okay.
Does that make sense?
Yep.
Okay. So you'd switch this to buy put.
Puts. Okay, yeah.
And then with put, it's the opposite. So in the money now is going to be anything above. And out of the money is going to be below. So these are in the money. The 465 is in the money for a put. 460 is out of the money. Okay?
Okay, so let's go for...
You can see how out of the money you're going to be cheaper.
I'm thinking about the 455s.
455s are actually $455. That's crazy.
Right?
Yeah, you have 500. So you could buy one of these.
What's your opinion?
I think if we go way out here, like you could buy a ton of these.
Oh, wow.
You could also buy
but that's way
30
riskier.
contracts.
I don't think they're going for 20. I would go like in the middle somewhere.
Okay.
So I guess we could go for 445 and we could buy 2 of these and then go for some
Okay, it's up to you. I don't want to say anything else. Again, we're trying to simulate like what a beginner would do, which is come in with their $500 account and throw it all on some random option contracts without knowing anything.
Okay, yeah, so I guess for these, 2 of these.
Yep, you just click on there. And now how many can you buy?
You can buy 2, right?
2 contracts. We could buy, looks like maybe 3, no, more, 4 contracts.
Oh, that's perfect.
Perfect. These contracts are 122, between 122 and 124.
Okay.
So you see how there's 2 prices? There's a bid and an ask.
Yep.
Now, the bid and the ask, these are known as a spread, like the difference between the bid and the ask. So like if you're coming in and you're buying option contracts on a company that no one knows about, there's probably not going to be a lot of people trading those contracts.
Yeah.
Whereas Tesla, everyone knows about Tesla, everyone's trading them. So there's going to be a smaller spread. $123 and $125, that's only a $2 spread. You know, it's fluctuating between a $1 and a $2 spread. Now, you always got to look at the spread. You want to know when you go to buy these contracts what the spread is, because you want to pay the least for them.
Yeah, we don't want to overpay.
Possible. Right? You don't want to overpay. Yeah, so like right now, 119 is the bid. So you would want to send in what is called a limit order.
Okay.
A limit order, you're specifying the price you want to get filled at. And it doesn't mean you're going to get filled because someone actually has to sell to you at that price.
Yeah.
And then a market order, with a market order, we could do a market order, which you would just go here and you'd switch it to market. Now, if you sent this through, you'd more than likely end up overpaying, or you'd pay the ask. So it just depends. If you really want to get in right now, you'd do market. If you want to get your price, knowing that like you might have to send in another limit order if it doesn't get filled. If that stock is moving a lot, then you'll send in a limit, and again, you might have to adjust that. So if we send in a limit right now at 119,
I think 119 is reasonable.
We'll send that through and we'll see if you could get filled.
118 is not possible, or is it?
Well, actually now it's 115.
Yep.
So you see how the spread is shifting? So let's try 115 and let's send that through. Oh, 113.
Maybe we should wait for like 1 minute. Or it's going to go up. Let's go 115. Oh, 114.
114.
Review,
and then swipe up.
Swipe up.
All right.
Okay.
I always say, though, I will say, this is advice I give the mentorship, right? So I was telling you, I trade live every single morning. Everyone can kind of sit over my shoulder like you are, but watch me on Zoom and watch me enter and exit trades. And I always say, like, never sweat an entry. So if I'm in this situation where I'm on live and I'm looking and I'm like, okay, you know, I got to get in. I'm not getting filled. I tried to get my price right away. It's starting to move. Well, that trade, this has happened before where I ended up passing up on the trade because I couldn't get filled for, you know, that $2 difference, which was only a percent or two. And I missed out on an 80+% trade. So at the end of the day, don't sweat the entry. It's not going to make or break your profitability overall. And if it does, then you're not trading a really profitable system. Okay. So I would give it like a couple more seconds here and I would just go and get filled. I would just get in.
So at this current price, not.
So now we're already 119. So like you could see, I mean, we don't know what's going to happen when we check back in at the end of the video, but you could end up missing out on a huge move if you don't get filled now.
Okay, so let's replace order, right?
Oh, see, the contract's value is going up. You're right now. So Tesla's going down right now. Even though we can't see it, it's going down. Because those contracts are getting more expensive.
I should have filled.
See, never sweat the entry.
Oh, no.
Now, this is a really good lesson because like everyone gets to the point where they have to click buy. Now you're seeing the stock move away from you. In your favor in this case. The price of the contracts are getting more expensive.
It's in my favor, but I cannot buy it.
Yeah.
I haven't entered.
And
the way I predicted.
You might have to be like, oh, I can't get in at all. Like, I just missed the trade. Oh, so now you're over your $500 account. So you actually have to buy less contracts now. So let's see. We'd have to switch this now. We're at 130 to 3 at 129. How do we feel about 3 at 129? Let's see if we could get that.
Oh, I see you got them.
All right, come on. Let's see if we can get this filled.
Why?
This is crazy.
It's running away from us.
Oh, you're filled.
Okay. Got it.
All right, so at the end of this video, we're going to check back in and we're going to see if you ended up making money or if you blew up your entire $500 account. So what we're going to cover is going to be a swing trading strategy. So there's swing trading and there's day trading. Now, a day trade is when you enter and exit within the same day.
Yep.
Okay, you're buying and selling within the same day. A swing trade is when you buy today and you sell tomorrow, or it could be a week or even a month from now.
Okay.
You could have a 3-day swing trade, you could have a 3-month swing trade. So we're looking at a 4-hour. So each candle represents 4 hours of time. And I've gone ahead and I've applied these 3 moving averages, okay? So we've got 2 simple moving averages and 1 exponential moving average.
So the exponential is going to be more sensitive to the movements. It's going to move more rapidly, am I right?
Yes, so this one is a 15-day exponential moving average. Okay, then we've got the 180-day simple moving average, or SMA, and then we've got the 50-day SMA. Yep. So using these 3 moving averages, the whole idea is that we're visually going to look at different stocks, look at the chart, try to identify where candlesticks are trading at in proportion to where these lines are.
Okay.
So this moving average just represents the average price over that specified duration of time. And so the shorter moving averages are going to be more like sensitive.
Yeah.
They're going to be tighter to the actual candlestick. Those larger moving averages, like the 180-day SMA, they're going to be
like the long-term trend.
It's a longer, bigger picture, longer-term moving average, which we can also use. Okay. So there's support and resistance. This is like a concept that you need to understand.
Yep.
Support is like a floor. Resistance is a ceiling. And so based off of where these candles are trading at, in, again, correlation to where these moving averages are, the moving average is either going to be a support or a resistance level. Okay, so for example, I don't love this chart, so let's just pull up a random stock here. Now, what we can see is that if candles are trading above the green line, that means that green line is going to be acting as a support level.
Yeah.
Okay, so we're trying to identify charts that, in this case, for this strategy, candles are trading above the green line. Okay, so that's the biggest thing.
So that's bullish, right?
That's bullish. Yeah. So when a stock is moving from the bottom left to top right, that is a bullish trend. And when a stock is moving from the top left to bottom right, that is a bearish trend. I'm going to pull out my drawing tool here. So yeah, this would be bearish. This would be bullish. Yep. So we're looking for stocks that are trading above the green line. Okay, this is the green line right here. And so, for example, Citibank is trading above. Okay. Yep. Now, we look at the 50-day. We look at the 15-day. I use this word, it's called respected. Now, some charts are going to respect these levels more than others. And what I mean by that is when you look at how the candlesticks are trading, if they're trading on top of a moving average, okay, so for example here, if we look at our red line, our 50-day, I'm just going to draw on our 50-day, you can see how candles, you know, our candles are just trading on top of it, like kind of just all over it.
Yeah.
You know, it's not like it pulled back here and then bounced off, pulled back and bounced off. It's not respecting the trend. It's not respecting the moving average.
Yep.
And so when it's not respecting it, it means we're not going to be able to use it as a support or resistance level. And we're not going to be able to rely on that as an area to set a take profit or to set a stop loss. So when we look back, this is again a 4-hour and it's 180 days. So we're looking back over the last 180 days.
Yep.
And the more we could see, the more times that stock is respecting our moving averages, the better. Okay. So the setup we're trying to identify is one, going to be a bullish trend where candles are trading above the 180-day SMA. The longer, and so the further back, the better. Okay, like the beginning of this period, and again, we're looking back 180 days, you could see how candles were trading below.
Yep. Like
clearly because the line was here. And then when we broke above, you could see how many times we came back into the 180-day and bounced off. Yep. And so it's been several months of trading above. And at this point, where are we now? We've come off of our all-time high and we're trading back on the 180-day SMA.
Yeah, but if it pierces this line, it's probably going to go down, right? So can we tell whether it's going to pierce it or bounce off, or is that more like random?
So here's the thing. When it comes to timing a trade, and if we look back here, okay, look how many times it did pierce it, but then it ended up remounting. Yeah. Like it did slightly dip and drop below, and then it remounted.
So we could treat that as
slightly
like
dipped below, remounted. The more of that, historical pattern we can see that has played out over and over and over. Again, we've just looked back. We've identified once we broke, obviously, above the 180-day SMA back here, we actually haven't been able to invalidate that as being a floor or a support level. It's been a support level, but the market probes moving averages. It will drop below temporarily. It does this to shake out traders because most traders, a lot of them, could be looking at the same moving average, right? And they will have set their stop loss at the 180-day. And so the second price breaks below, they're selling for a loss, right? Every time it slightly broke below, they're selling for a loss, for a loss. So we don't want to do that. We want to give ourselves a little safety net and account for that. We do. We want to be smarter. Exactly. Yeah. So if we're looking at where we're trading right now, this setup, we're trying to essentially identify what we just talked about. And at this point, now that we've moved back into the 180-day, right?
Did we pick a perfect stock first try?
It's
we did. Good looking chart, right?
This is a good looking chart, and it's got the setup that we're looking for because at this point, we would like to essentially buy calls and bet on the stock A to move back up to that all-time high. Because we could see every time that it's pulled back to the 180-day, it's made a new all-time high. Every time it might take a week, might take a couple days, but every time it always leads to a new all-time high because we're trading with the trend. The trend is bullish. That means higher highs.
And we just bounced off.
It keeps bouncing. Yeah. This is a very, very strong level of support. It's a strong floor. Now that we're coming down here, what I would do is give this is our rule, 2 to 3 candles. These are 4-hour candles, okay? So it would be 2 to 3 4-hour candles. And what we want to see is that once we have seen a candle form below, okay, the 180-day SMA. This is the 180-day SMA.
So we want the wick to be below.
The wick to be below. Yeah, the whole majority, the entirety of the candle, right?
Yeah.
We want to see form below. Right now, the wick is touching it.
So not yet.
So same here. Look at, boom. We ended up closing above. The body closed above. We wicked below. So we want to see, again, 2 to 3 4-hour candles invalidate this 180-day SMA and close below without touching it, right? Because then at that point, we could be even though this has been 8-9 months where it's been respected, we've given it a solid, just about a trading day where it's closed totally below and it's still not touching. You could see here how we never would have gotten stopped out. We never would have gotten stopped out. If you would have stopped out on a wick, you would have gotten stopped out every time. But with our rule, look back at these 3 examples, okay? Do you see an instance where we would have stopped out, where there were 2 to 3 4-hour candles that closed below the 180-day SMA and did not touch it when they closed below?
Not a single one, right?
Not one. I don't see one, right? Yeah. This one closed, touching. This one was touching.
This one's close.
This one's close.
But it's not close.
But that's why we would give it a second. And then if it was still close, look at that. So that's just the market and the behavior of a market to take out traders that don't understand this. But with this setup, again, I'm feeling really good about this stock. We kind of fell on a perfect one.
Yeah.
We could then go and we could buy an option contract. We could buy a call, and we would then set our take profit. What I like to do is set it slightly below the all-time highs. So you can see how it wicked up here.
Yep.
I would set my take profit at the body of that candle. So
at 158.
We'll make this green. And I would feel really confident with buying calls right now, setting our take profit at 158 roughly, right?
Yep.
About 158. Now, we are again, we're going to have to wait for this 4-hour candle to close, but so far this one's good. So again, 3 to 5 days is my average. What we would do is as soon as we get that 2 to 3 candle close below, not touching the 180-day, we understand what that would look like. We'll give a couple examples because I know we haven't really looked at any examples where it's closed below because this is a great chart.
Yeah.
Then we'd stop out. We take a loss. So, I mean, proportionally, we might end up getting stopped out. And keep in mind, it's a moving average, so it's going to move. Maybe it'll be here by the time we get that. that move. And if you draw this out on the chart, that could be like a 1.5% downside. And on the other hand, we've got like a 12% upside.
Yeah.
So
that's low risk, high reward.
That's pretty low risk, high reward. Exactly. Yeah. We've got really great upside with really minimal downside.
Yeah. So even if you lose, like, you still took the chance and could gain a lot of money if you made the right choice, right?
Yeah.
Like if it went up, like, you gain a lot of money.
Yep.
Like, how much would you go in with,
So when it comes to like your position sizing, obviously
Yep.
depends on how much you're trading with. Kind of a rule of thumb is don't exceed 5% of your account per position.
Okay.
So like you just put your whole account on Tesla puts.
Yeah, that's not the best choice, right?
We'll see if it was a good choice or not. But at the end of the day, you probably shouldn't have bought, any more than 5% worth of Tesla puts. And I know that's not a ton of capital to trade with when you look at 5% of 500, but that's a small account to start with. So that's like a general rule of thumb. So if you enter this trade, one of the things we're going to track as we start taking many trades, we will log our trades and we'll understand what our win rate is. So how many we win and how many we lose. And then that will help us obviously gain an understanding on if this is going to be profitable over the long run or not.
Do you ever go in with more than 5% if you feel really confident?
So it would have to be backed up by some sort of data. It's never going to be, I'm never going to make a decision based off of intuition when it comes to risk management and position sizing. I would have to keep track of my setups. So this is one, okay? This is like what I refer to as my golden setup. Now, with the other setups, I know some of them have lower win rates than others, and some have higher win rates. And so I can use data to then back up, should I put more capital behind this trade or not? So let's say, and by the way, this setup has just about an 80% win rate. So about 80% of the time, you're going to be right on this one.
Oh, wow.
Now, there's like a confluence to this, which is going to be obviously measuring out the distance and the duration of time this could take. So we understand it's about 12% to the upside, 1.5% to the downside. I've got a tool that I can throw on here, which will give me a projection on how many days realistically, based historically, off of how this stock moves, that's going to take. Okay, I could throw it on here right now just to see. And so what this is going to do is it's going to tell us, okay, our average daily movement is about 1.5%.
Okay, so it's like it's going to take like 9 days, right? Because we're going 12% up.
Yeah.
And this moves 4%.
We can punch it in here.
Days.
Let's see, 9 days, you're saying?
Yeah.
So 13. Yeah, so I would say
9 days,
8
right?
or 9 days it's going to take for us to hit our take profit if we move straight up into there. Whereas on the other hand, 1 day to hit our stop loss. So now we have some context as to like when we expect this move to happen.
Okay, when you make a trade, do you watch the chart all the time or do you just leave it there?
No. So what I'll do is typically I'll look in the morning, I'll look before the market closes. That's when the most of the move happens. Stocks move a lot the first 30 to 60 minutes of the open and the last hour of the close. Okay, so I'll check in, but I'll have alerts set. So I could set an alert, I could right click, I could just create an alert here.
Yep.
I could say, okay, I want to be notified if we hit 157.75, and then I would create that. So now, if all of a sudden for whatever reason, A moved up 10% today, I'd get notified on my phone that we hit my take profit. We'd log in, we'd close the trade for a win.
And have a great day.
And we have a good, Same thing goes for our stop loss. I would just set it like a little bit below here. Again, this is just me trying a line just to kind of give you an idea.
Yep.
But we can be like, okay, 1.55% is our average daily. Let's just draw down 1.55% below where we're currently trading.
Would this be like your typical risk to reward ratio, 1% to 12%?
No, this is a pretty, so let's say roughly that's our stop loss.
It seems a little bit
good. This one, if you were just to calculate the risk to reward behind the actual share price, what was it, 12 or 13? 12. So let's say 12, and it's a 1.5% downside. We want to calculate it exactly. So we could get the risk to reward. We would go here. And we'd have to do this with the actual option contract we decide to buy. Mm-hmm. We've actually dropped like 1%. So now if we entered, it would be 15% to the upside. So this thing's moving quite a bit. So 15, we just do 15 divided by what's our downside? 1.5. So
10.
it's about a 1 to 10 R. So our risk is, relative to our reward is very disproportionate. My average is a 1 to 3 R.
Okay, so this is a low risk trade.
It's low risk trade, high reward, but in that case, probably a lower win rate. When we set, and typically when you look at someone's trading performance, if you see they have a very high win rate, they're probably not risking much in proportion to how much, they're making. So a high risk to reward, it's a lot to kind of comprehend. I know this is all very new to you.
Yeah, but I think I get it. Like, there are not many trades that allow you to make a lot of money and not be risky at the same time.
Yeah, if my average risk to reward was a 1 to 10, I'd probably win like 20 to 25% of my trades. Okay, and that's fine. You can actually be profitable with less than a 50% win rate. It's not all about that.
Yeah, because you make more per successful trade.
Exactly.
So,
You can take more losses and endure more drawdown until, obviously you have that one winner that makes back all your losers and more. So a lot of trading is just very simple math, and it's just taking this balance. What is my average risk to reward and what is my win rate, and then figuring out if you'd be profitable or not. And I have like a calculator I could throw that in and see in 2 seconds. I want to have you now skim through some stocks, and I want you to try to on your own identify this setup. So what we just covered, and we'll see, let's remove the ADR calculator, if you can find a solid trade, and then we'll mark out that trade plan. So first we'll have you identify the trend, just to
so that's,
keep things simple.
Yeah, that's bullish, right?
Definitely bullish.
That's bullish because it's above the 180. I wouldn't go in on this.
I don't like it either because there's not a huge amount of historical like trend above the 180 day. Like half of the chart we're almost trading below or on it. And again, the idea of the setup is we're looking for a bounce off the 180 day and a move back up to that all-time high. That's it. That's the setup.
So we're only looking for bullish. We're not looking for bearish markets where it would like bounce off of the resistance, right?
Correct. Off of either, so we have other setups. And we have both bullish and bearish setups where we can identify, in any market condition, a trade opportunity. But today we're just going to cover this one specific one. I'll get you in my mentorship where you can learn the other setups, and you'll obviously have like the full toolbox to do all of this. But we'll just cover this one in the video today.
Okay, so I guess we keep going because this one's not good.
No, I don't like that one. A, B, and B. Wow, look at that one.
That's not what we're looking for, right?
That one's a mess.
Yeah, that one's way too messy. Yeah, and it just turned bullish, right? Like recently.
Recently broke back above the 180 day, but it's totally choppy, not clear at all. We want a really clean and clear chart where moving averages are respected.
This is bearish, so we're not looking for bearish markets.
Bearish and really, really choppy, not clean, not clear. Same thing.
Oh, this is terrible. That's good.
It's pretty good.
Yeah, that's perfect.
Look at where we're trading at, okay? So let's look at the historicals. Is this bullish?
Yeah.
Bullish. How many tests? Let's say 1, 2, 3, 4.
Almost 5.
That was kind of a fifth. I mean, so we're seeing higher highs.
Yeah, and higher lows.
And higher lows.
So we're going bearish.
So this is looking
bullish,
very bullish, very good. Look how clean that is. So now what do we expect to happen? Boom.
Boom, and then
boom,
goes up
boom.
again. Yeah.
So where would we set our take profit and where would we set our stop loss if we entered right now?
So if it were me,
just point at the screen and I'll draw it for you.
Okay, so
if we entered right now,
I'd draw like a line like this,
like a sideways line.
Yeah, going from this to like
a trend line,
45-degree angle, or like, and it kind of aligns with the average. So I would set the stop loss like right at this line.
Okay,
probably.
That's interesting. So you would like to set this, lay out a trend line where you're matching up that previous higher low and current price.
Yep.
And then you're saying, hey, I see the 15 day.
Yeah.
So that's not how I would trade the setup. That's cool.
Yeah.
Right? So I don't trade trend lines. I think like fundamentally I don't, and I've never been able to find a way for those to work for me.
Okay, so the line I drew is not
it's a way someone would trade, but just not me.
I saw people on YouTube doing that.
Totally.
Yeah.
I've never found that to work.
Okay.
Because again, you are now only working with one data point.
Yeah.
And you're like, okay, this is one data point to make this decision, whereas we want to look at like a half a year of data.
Yeah.
And what was probably going to happen, what's predictable is that, yeah, we will come back. Okay, well, this is going to move up a little. We're going to hit the 180 day, and then we're probably going to bounce back off and move up to the all-time highs. So like with the setup that we're looking for, if we entered right now, I would consider this to be like an early entry, because our stop loss theoretically at this moment would be here. And it would be like after that,
that's
1, 2, 3 candle closes below. And then theoretically our take profit would be here, maybe like a little bit lower, right?
Isn't that like a negative risk to reward ratio here?
So we can see, let's do this. Okay, yeah, so technically based off of our setup, right, we're looking for a bounce off the 180 day and a move back up to the all-time high.
Yeah.
So our risk is gonna be this. Our reward is gonna be this.
Not worth it.
So maybe it is based off your win rate. Maybe it's not. Visually, it doesn't look worth it. Let's see, let's chart it out. We've got to the upside, 3%, and to the downside, we've got
7.5.
7-8% roughly.
Is that like a 2-to-1 risk?
It's an inverse risk reward, which again, could be profitable if you have a really high win rate. Really, really high win rate. I don't know what the break-even win rate would be, but it would be really high. So I don't love this one. Let's try to find another example where like the risk reward looks good. And again, I think this chart checks off all the boxes, like from the perspective of how the moving averages are interacting with the candles. That looks good. We've had many, many tests. Historically, this pattern looks like it's going to continue to play out. I think just the timing is not great right now. Do we want to check in on your trade?
Sure, let's go.
Okay. All right.
I'm excited for the result.
Ready?
So we're not.
So you lost a little. You lost a little, but it's not bad. It's not bad. Yeah. You actually have come back.
Yeah, it looks like it.
You're down $15.
Yeah, so that's not bad.
3%, but you were down. Let's see how much you were down. 10%.
Almost $50.
Ooh, $50.
Yeah.
But okay, now you're only down to 2.5.
So maybe it will change a bit more.
Yeah, and I think, remember, you didn't understand any of this.
Yeah.
You took this day trade, the short-term trade. You bought really risky contracts. You didn't understand, like, when you looked at the chart, really the tools like that you needed, you didn't have to make the right decision. You pretty much, you gambled.
Yeah, that's pretty much going to the casino, right?
Right, and so that's a lot of people. So, you know, don't let that be you. You know, you got to educate yourself, whether it's through the mentorship, through me, or someone else. Learn the right way to do it so you're not in that position where you've lost money.
Maybe we could take a look at the chart and see if I made the right decision. What do you think?
Yeah, let's do it. Let's see.
Something we would do if we look
we're going to stay in your trade, or are we going to close it? Because it's still going up and down.
Now, based on this.
We can decide right now if you want to stay in or not. And I will say, when you're thinking about day trading and swing trading, you are now like comparing. It's not apples to apples. It's apples to oranges. Like they're two different things. And so I think looking at Tesla, we bought puts,
and it looks like it's going to the average, and then it bounces off, and now it looks like it's going to the average again, right?
But let's talk about the setup that we covered today. If we're looking to trade calls, we're already wrong. Like, we should have taken this based off of that.
Yeah, because it's not. Yeah, we should have.
Because this isn't a short
calls.
setup.
Yeah.
Now, if we took calls, we'd set a stop loss about here. Okay.
But we went the other way.
We went the other way.
Yeah.
We would set stop loss and take profit, and we try to play the move here. Whereas now we're short, we're trying to play the move here.
It's not looking bad.
I mean, technically you could be like, oh, it does actually seem like it's going to go down to the 180 day. But how many days is this going to take? It's not minutes, it's days. Yeah. Right? Like, well, I will say you are in the green now.
We made $3.
Waiting a couple extra seconds maybe has worked out in your favor. What do we think? How do we feel? Do we need to start diving into day trading strategies now? Let's close this out. Oh, look, we're up. We're up.
$12.
Okay, let's close it out. Let's close it out. While you're still in the green, let's close it out.
How do I close it?
Go here. Trade.
Sell.
And let's get in a quick limit 134 for 3 contracts.
3, 4.
Here, these are your
no.
135 here.
Fine.
And then change this to 3. Okay, send it.
Review.
Send. All right.
Okay.
And you're filled. Let's see how much you ended up actually making.
Done?
Yeah. Let's go back to
how do I see how much
your
I
home.
made?
Oh,
$20.
$20.
That's solid,
Okay.
right? That's solid.
4%.
I didn't expect it.
Wow.
I mean, I did expect to make money, and I was kind of thinking like maybe we would be like $200 up.
Okay.
But it's still good. Like
That's still.
we're not in the red.
You were
so
just
that's
in
most
the
important
red,
thing.
so you just recovered, and now
Yeah.
you're green. So that's great. That's sweet. I mean, that was like an hour, so that's not bad. $20 in an hour.
Yeah, that's like a meal.
All right, we'll get you in the mentorship. If you guys want to join, I'll put a link in the description below. Come trade with us, and we'll see you in the next video.
Yep.